To start the conversation, I'd really like to have a look at some of those key people and ideas involved underneath ETFs, because we often look at it from the surface level. And that's how we often talk about it, because it can get a little bit confusing. Yeah, but underneath the neat, attractive packaging of an ETF, where it's all packaged up nicely for the consumer, I want to talk a bit more about how they actually work. And one of the first starting points I thought we could talk about, Evan, was the open-ended structure of ETFs, because that's quite a new concept for some people.
Sure, yeah, no problem. So I think when most people think about ETFs, the first thing that they think about is that they're funds. I think most people understand that they're kind of similar to a managed fund, but the main difference is that they trade on exchange. And not only do they trade on exchange, they trade on exchange at a price that somewhat reflects the value of the underlying portfolio. So that's a little bit different from a managed investment, like a traditional unlisted type fund. It's also a bit different from a listed investment company or a listed investment trust, so licks and lits. Mm-hmm. So for most people, they understand that's what an ETF is, that's how an ETF works, and they're able to successfully trade ETFs based on that, but they don't necessarily always have the opportunity to look underneath and see what actually happens. So to explain that, we need to introduce the concept of the primary and the secondary markets. So there's two separate markets for an ETF that interact with each other. So in the primary market, investors are able to come directly to the fund manager. They place orders with the fund manager themselves for either the creation of new ETF units or the redemption of existing ETF units. So this is exactly what happens, exactly the same as what happens in the unlisted fund world. So what happens there is that someone will come to the fund manager, place an order, and they're given a price at the end of the day. So they're creating an end of day. At the end of the day, they're creating new ETF units. The only difference with an ETF in this respect is that the primary market is only open to investment professionals known as authorized participants, or APs. So they're one of the key parties involved in the ETF market that we need to understand. So an AP is usually a major investment bank, a securities house, or a trading professional. So they're the companies that can create and redeem units directly with the ETF issuer. The other market is the secondary market. This is what most people are more familiar with. So this is where you trade ETF units on the stock exchange. So buying and selling in the same way that you would buy and sell a share, and in the same way that you would buy and sell a lick or a lit. So the secondary market here is supported by not just end users of ETFs, but also by parties known as market makers. So these are effectively liquidity providers to the ETF. So they're often, but not always, contracted to the ETF issuer, and their job is to provide buy and sell prices, so bid and offer prices on an ETF continuously throughout the day. And this is what effectively allows people to trade on the secondary market. So you have these two markets, the primary market and the secondary market, and they're linked. And the reason that they're linked is because there are participants who can trade in both of those markets. So if you have the situation where those two markets are pricing an ETF at different levels, then you effectively have an arbitrage or an opportunity for someone to make risk-free profits by buying the ETF units in the cheaper of the two markets and selling them in the more expensive of the two markets. So it's really this interaction between these two markets that is the key feature of ETFs, and the kind of special sauce that makes ETFs what they are and keeps the price of an ETF at or very close to the value of its underlying portfolio.
So Evan, if I'm a consumer using my Perla or my Stake account, I would be purchasing ETFs via the secondary market, is that correct?
Yeah, that's right, exactly. Yep. So secondary market is what most people trade in and out of. That's what happens on exchange. That's what people see in their brokerage accounts. Primary market is for specialized investment firms only.
And so those specialized firms, those authorized participants, do they effectively collect all of the, say if there's like an Australian shares ETF, they collect all of the shares and then hand them to you, the ETF issuer, in effect?
Yeah, so there's two different ways that the primary market can operate. So there's in cash and in kind creations and redemptions. So an in-kind creation or redemption is, as you described, where an authorized participant would buy up the securities that form the underlying portfolio for the ETF and deliver those to the ETF issuer in exchange for newly created units in an ETF. The other alternative is cash creations and redemptions, where they provide the ETF issuer with the value in cash of the underlying securities, and the ETF issuer then goes and invests that in the fund. So there's two different models, but they effectively provide the same outcome.
And I find the idea of market makers really interesting, because unlike shares in a company where you would be buying and selling to some other individual or bank or something like that, with a market maker, they can keep creating more units of the ETF, and you're not always buying directly from another participant, from your mate who also has that ETF they want to sell. You could also be buying newly created units in this ETF that the market maker are creating. Yeah,
that's exactly right. So a market maker will usually maintain a certain amount of inventory on an ETF. So it'll be like think about it like a supermarket where they have stock on the shelf, and they're able to offer that to end investors via the secondary market. But they're also simultaneously offering to buy units off investors who are wishing to sell. So they're there in the market all the time. When you trade, chances are you probably trade with the market maker, but not necessarily, because there's other buyers and sellers in there at the same time. So it can be retail investor versus retail investor, or other types of investors interacting with each other. But market makers will be there providing liquidity on both sides. The more market makers you have, the more competition there is, which usually results in tighter bid offer spreads, and then better outcomes for end investors as a result of that as well.
You touched on liquidity there. Are you able to explain a bit more about what that means in the context of ETFs? What an investor should really know about or have a look at if they're trying to understand how easy it will be to buy and sell units in an ETF?
Yeah, sure. So market makers will provide the underlying liquidity, and they generally are contracted or otherwise incentivized in some cases, not necessarily, but some of the incentive can just be their own trading objectives. But they'll provide a certain amount of liquidity on screen at any time. But that's not necessarily reflective of the underlying liquidity of an ETF. So you can look at either how much liquidity is on screen, so how much in, say, dollars you can buy and sell of an ETF. You can also look at how much a particular ETF trades historically. Both of these aren't necessarily very good indicators of how much actual liquidity there is in an ETF. So if you look at historic trading volume, that's probably a bit more of a signal of how popular an ETF is and how many investors are trading, but doesn't really tell you about how much you could trade if you wanted to really trade a large amount of a particular ETF. So to understand a bit more about that, you have to look at the actual portfolio of the ETF and see what it's made up of, what the securities are in there, and what the underlying liquidity of those securities is. So in theory, an ETF is really just a wrapper and just effectively a look through to the underlying portfolio. So if the underlying portfolio is highly liquid, say ASX 200 stocks, then trading liquidity of the ETF, or theoretical at least liquidity of the ETF, is more or less unlimited from the perspective of most investors. I think the only other thing to consider, aside from the liquidity of the underlying investments, is which market makers are involved in the ETF. So certain market makers, when they hold inventory, when they create and redeem, there's a funding cost to those market makers. So certain market makers might have access to more capital and be able to trade in larger parcels. But yes, for most investors trading ETFs on a daily basis, that's not really a concern, but it's worth understanding just in terms of how it works at the sort of institutional scale as well.
Yeah, that's really interesting, because I've seen a few questions pop up in our Facebook community before when someone's been looking at a particular ETF. It might be a little bit more niche, and there's only been one trade in the last day, and they were going, oh, is that a bad sign? Does that mean I won't be able to buy and sell in the future? And I guess you answered that question, because different ETFs aren't always as popular on individual days, but because of that market maker and the liquidity, it doesn't really reflect necessarily that the ETF is not a good ETF just because there was one trade yesterday.
Yeah, exactly. When ETFs trade a little bit thinly as well, sometimes market makers aren't always showing the sharpest prices. So I think it's quite often worth contacting an ETF issuer in that case, because there's potentially opportunity to get some better pricing in the market if there hasn't been much activity for a little while in some of those funds.
Yeah, and just to confirm what Kate said there, you can check that by looking at in your brokerage account, seeing how many buys and how many sells there are, and seeing the trade history there as well.